Investors are constantly trying to determine if the global economy is speeding up or if it's slowing down. Finding an accurate answer in real time determines how capital is allocated. To find the answer, most market participants look at the numbers common in the financial press: gross domestic product, monthly employment figures, and industrial production data. Building a portfolio around those numbers often leads to a timing mismatch. GDP and employment are lagging indicators. By the time they show a clear decline, financial markets have typically already priced in the shift. This chart shows two economic trajectories. Markets don't care about the absolute height of the growth curve. They care about the slope. 2.5% growth is bullish if improving from 1%, but that exact same 2.5% is bearish if deteriorating from 4%. To stay ahead of these shifts, an investor must identify turning points in momentum before official, lagging data confirms the change. One tool designed to detect those turning points early is the OECD Composite Leading Indicator, or CLI. Instead of past output, the CLI bundles forward-looking metrics: manufacturing orders, business sentiment, housing activity, and rate spreads, combining them into a single trend line. This unified line frequently changes direction months before official GDP or employment reports. Tracking one country's CLI provides a local warning system. However, in a deeply interconnected global economy, no single nation moves in a vacuum. Economic expansions and slowdowns transmit across borders through supply chains, trade networks, and capital flows. To measure this global spread, we use the OECD CLI Diffusion Index. Rather than measuring the specific growth rate of any single country, this index asks a simple question: how many major economies are accelerating at the same time? The index maps the spread on a 0 to 100 scale, anchored at 50. A reading above 50 means a majority of global economies are improving simultaneously. Conversely, a reading below 50 means more economies are deteriorating. When the diffusion index breadth expands past 50, it signals that local improvements are becoming a synchronized global expansion. When the index rises and the global cycle broadens, that environment has historically favored cyclical equities, small caps, commodities, and credit. When the index falls, capital tends to rotate away from risk and toward defensive assets and higher quality exposures. Logic Macro Regime uses this diffusion index as the primary momentum signal for their growth cycle component. Logic combines the growth cycle and inflation cycle to map four distinct macroeconomic regimes. Rising growth drives Goldilocks, where inflation is down, and reflation, where both metrics accelerate. Falling growth drives inflation, where inflation stays high, and deflation, where both slow together. By tracking the breadth of the OECD CLI Diffusion Index, Logic filters out the noise of lagging statistics. This provides a systematic way to adjust risk bias and position portfolios before the turn is eventually confirmed by standard economic reports.